the last 20 years. I'm wondering how investors feel at the point that, is it becoming that it's not appropriate for individual investors for the long term, and is more appropriate for those high-frequency traders in the short term, especially since you highlight that people are only holding stocks for 130 days?
I'll be happy to take an initial swat at it. So when you say market structure, I'm not quite clear what you're reflecting on being different today. Did you want to just specify? I'm on a committee at the New York Stock Exchange, which is the Individual Investor Advisory Committee. I've been on it for 10 or 11 years now. At the very start of my tenure there, the big debate was decimalization. What will it do, and should the NYSE be enabling it and happy about it? I'm sure a lot of people in the room remember we used to say that a stock was at 17 5/8. So you're right. The nature of the markets themselves, high-frequency trading, which is often made to sound like Armageddon for investors, I have very mixed feelings about it. I'm not highly negative on it, but it's no question it's a change in the market structure. The majority of volume on the New York Stock Exchange today is not even done by or on the New York Stock Exchange, and is being done by computers, automated to act within milliseconds. If that sounds scary, I think aspects of it are. If the Motley Fool had its way, we would probably have 1 minute a day that you'd match up orders, and then we'd all be done with the stock market, and then you could trade the next day if you wanted to. These kinds of leveraging up and making big bets inside of seconds is troubling. At the same time, it does create liquidity. There is the opportunity. These days, if you're a stock investor, and I have to make new stock picks 3 times every single month and have done so for more than 10 years. So I'm basically always in the batter's box. And I've watched, as I take swings out there, the scores that I'm now getting are based on stocks that I'm getting trades filled at 17.4324. I mean, we're taking it out to the 4th decimal. But it's becoming increasingly difficult just to add that $9 commission and figure out what my cost basis is, because we're down into the 4th decimal point. So there have been a lot of changes, but I think the fundamental basis of becoming a part owner through our markets and looking 3 to 5 years ahead, those things are all absolutely possible. In fact, the more that we get myopic, the more that big money and institutions are focused inside of seconds, I think the smarter and smarter it is to be playing a completely different game, which is the longer term game, 10,000 feet higher, thinking about where Facebook is going to be 3 to 5 years from now, and not the last 3 months.
Doug, you wanted to speak to that?
Yeah, I just want to say I agree completely with David. You can have concerns about high-frequency trading and other market changes, but if what you're doing is real investing, you're buying something now with the intent to hold it for years at a time, it doesn't matter all that much exactly what price you get in at and exactly what price you get out at, which is what's being affected by most of these market changes. If anything, you're probably in a better situation because, as David's pointing out, a lot of the street now is distracted by much shorter term issues. So the possibility of applying your actual knowledge of the world to notice an opportunity that's longer term may be better.
Hi, I'm wondering if Ms. Fornelli and others might be able to elaborate on why financial advisors and brokers are ranked so highly in trust, especially given the fact that there's a lot of controversy right now about the fact that not all advisors have to act in the best interest of their clients. In fact, investment advisors do. Brokers simply need to sell products that are suitable. Do investors understand that there's a difference when they put this trust in them?
I'll take a crack at that, although this is why we have a panel here, because in the past, when we would get these kind of questions, I'm not an expert on these things, and so I probably shouldn't be speculating. I see my staff in the back waving me off, saying, don't answer that question, Cindy, but I will. I think that it probably goes a little bit to what Gail was saying. I think most people that we talk to in this survey are invested through mutual funds or 401ks. And so that's what they think of as a financial advisor or a broker. I'm going to posit that they don't make a distinction in their mind between a broker-dealer who, as you mentioned, has a suitability requirement and a financial advisor or an investment advisor who has a fiduciary obligation. That's just a higher standard. So I don't think that they do. And a little note on this, in the past, we used to ask the question, if you look at the survey results, the question is posed, other than yourself, who do you trust the most? Because we had to put that qualifier in there, because when we didn't, they ranked themselves far and above as the people that they trusted their most. So we had to take them out of the mix. But my own personal view is that they don't make that distinction, and they're probably looking to their mutual fund or their 401k advisors, and that's who they're talking about. But again, I'm going to turn it over to the panel.
I would say that, just real quick, I would just say that financial advisors, financial planners, it's a trust business. If you don't trust your advisor, you get a new one. It's pretty simple.
A lot of regular people dream of having a financial advisor to take care of them, but they don't really have one, because you have to have about $250,000 to invest outside of 401k to even interest one of those people. So for a lot of people, this is kind of a dream concept, like being able to go to the best brain surgeon if you had brain cancer. But among the wealthier individuals, there was a huge amount of churn. The people that did have financial advisors in the last few years, I was getting asked to speak to financial advisor conferences to help the financial advisors know how to hold on to their clients, because the wealthy clients felt like the financial advisors were supposed to keep them from losing as much money as they did the last few years. And they held those financial advisors accountable when they lost money. In part, that's because of the promise that the industry has provided. They've made it sound like you go to a financial advisor and that's where you make your money. They never said anything about you go to a financial advisor and we'll keep you from losing as much money as you would on your own. And so there was a sense of betrayal over the last few years and a huge amount of churn in the industry. But there is an issue going on right now about whether your advisor is there for your best interest or not. And very savvy investors are clued into that. They're paying attention to fees. They're paying attention to conflicts of interest. But that's not the rank and file American.
David, do you have thoughts on that in terms of reliance on advisors?
I think it is, to echo John, it is a relationship game and a trust game. And we've definitely been active critics of many aspects of the financial world over the last 20 years. And one of them is, how is your advisor in whatever way, shape, or form? And there's lots of different stripes and colors here. How's that person getting paid? That's probably the single best way to figure out who you should be working with. I like what you said, John. People eventually find somebody that they're comfortable with, and so they tend to say, I have great trust in this person. In some cases, they should.
And what about the notion that, I mean, you do need $200,000. In my experience, you really, to get a decent financial advisor, it's more like $1 million. Can people just get beyond that, and they can do it on their own without having that level of assets to qualify for?
I really think so. I mean, it all comes down to what we're talking about advice meaning or doing for you. If you're talking about making a plan, which is what a lot of financial advisors do, it generally makes more sense to have a plan if you do have a lot of money, and that's why that industry is totally set up to talk to people who do have that. If, on the other hand, you're just starting, you're trying to get rid of student debt, the advice that you can get today doesn't need to come from a so-called financial planner or advisor. Obviously, one thing we've done at The Fool is we've tried to create a community, a worldwide community of people who are essentially helping each other make better decisions together. Too often, the financial decision-making that we're required to do, and as adults, it's astounding. It's astonishing what you and I are asked to do. We have to make decisions about our wills and estates one day, but how to get a kid through college and which plan to pick there. What about your 401k? What do you do there? How about insurance? I've got insurance in 6 different categories that you need to make decisions on. And by the way, do you understand what a P ratio is? And the list goes on and on. So we're asked as adults today to make dozens of profound decisions about our finances. I know a few things well. There's a lot of things that I don't, like I let my wife handle our insurance decisions. I hate the industry. I don't like to think about it. I always feel like I'm wasting money. I think I am. It's a very powerful industry. Congratulations, Warren Buffett. So people tend to overrate, I'm sure people overrate Gail and me and others who are out there as faces on financial advice, because I only know a few things. That's why I really have benefited so much from having my own questions answered on my own site. And in general, social networks, the opportunity to share with each other, trade and exchange information when you're not working with a financial professional, but rather somebody who's also a peer professional of yours who has the same questions and has found a good source of advice. We can really socialize this much more and not make it so much about 1% of assets and, sorry, I only work with a certain kind of a person.
Well, and one thing, and again, this is a telephone interview, so you really don't have the capacity, GPG doesn't, to drill down in order to make it a relevant survey. You have to ask the same questions. But the question is not who do you trust the most, your financial advisor. It is financial advisors generically. So I think some people take comfort from the fact that there is this financial analysis going on out there, that there are financial advisors and broker-dealers. And while I personally may not have one, they're out there and they bring some robustness and credibility to the system. And I suspect there might be some of that in these answers.
Got time for one or two more if there's a question there? There's a mic behind you.
Thanks. Just two quick comments. One on the Fed's actions. In terms of investor confidence, it kind of would seem to me that the, as some say, radical and unprecedented actions by the Fed seem to indicate that Bernanke's more pessimistic about the economy going forward than less, other he wouldn't have taken such drastic actions. And two, just on the fiscal cliff, the issue we were talking about earlier, I think there's a lack of honesty surrounding the debate here in Washington. And, Mr. Elliott, your comments earlier that, Republicans just got to give on taxes, and then that'll get us through this, and if they just weren't showing transient. But one of the things the Republicans did, so the radical Paul Ryan budget, right, that's so onerous, balances the budget in roughly 30 to 40 years. So I don't think bringing our federal government's budget into balance over a 30 to 40-year time horizon is by no means a short time horizon. So to the extent that Republicans took the difficult, very hard choices politically of making structural reforms to Medicare, the biggest entitlement that all the seniors are very dependent upon, and now are getting beat up in their congressional districts, they went above and beyond taking that political risk to take that chance. The Senate Democrats, on the other hand, who haven't passed a budget in 3 years to show their longer-term projections on where they want to take the country, haven't taken that political leap of faith or that jump on what they really see. So if they don't support reining in entitlements to fix the economy on the longer end, and if you tax the top two bracket income earners at, let's just say 100%, you still don't come close to gaining the amount of revenue needed to finance the entitlement state. So then your only other alternative is to say, I'll support middle-class tax increases. And I'm sure senators like McCaskill and others who are out there running in competitive districts throughout the country, they don't want to have their name on a middle-class tax increase. But Republicans took that hard stance and said, we're going to rein in entitlements over the longer term and change them and fix them. Very difficult political.
I think we got somebody who likes Republicans. I'm going to let these guys jump in a little bit on that. Sorry to cut you off, but the Bernanke question is a good one. Does he, by his actions, indicate that he really thinks the economy is in trouble, Doug? And then the second part of it, I guess, would be to ask, in terms of dealing with the fiscal cliff, do Democrats need to be giving more on entitlement reform and not just a question of increasing revenues?
Absolutely. First of all, of course you're right. Bernanke is really quite clear. It is pessimism about the economy. He doesn't think it's about to go into recession, but he, like all of us, are frustrated by the difficulty in ratcheting up the growth to where we think it could be. So you're absolutely right. But I will say historically, and I've been following the market for a lot of years, markets almost always react positively to interest rate cuts, even in situations in which an interest rate cut might rev up inflation, as was true in some of the past years, and create longer-term damage. We could go into a longer discussion of why the market reacts that way, but the market is not always the best determinant of public policy in this area. In terms of your other point, let me say, I certainly didn't mean to indicate that the only problem here is Republicans. Both sides need to show greater courage. Both sides need to have greater clarity. The reason I singled out the Republican views on any form of tax increase is the Democrats seem to have significantly greater willingness to support spending cuts of some kind. Since I think the balance is going to have to be some of each, I think my political analysis is you could move the Democrats from where they are to where we need them to be. It's less clear to me that the Republicans can move without something shaking up the situation on the tax side, because there's such a strong political commitment to not let taxes go up by even $1. That's my view. I'm sure you differ.
Anybody has one last sort of yes or no short question? We probably have time for that. If not, I'd like to thank everybody on the panel. This has been a great discussion, and thanks to the Senate for Center. We're not thanking the Senate or the House for anything. We are thanking the Senate for audit quality, and all of you. We'll thank Gail and David and Cindy and John and Doug. It's been a great discussion. Thank you all for coming. I'll turn it over to Cindy if she has any final thoughts for us.
Well, I also want to thank our great panel, and I want to thank you too, Ben. You made the hour and a half go by very quickly. I wish we had more time, but if you all please join me in thanking Ben and the panel. And I want to thank all of you for coming here today. So have a great day, and we'll see you next year.